Hello again, everyone. This is Joe Henches with Beyond the Chart, your source for exceptional video analysis of stocks, ETFs, and indices. Today is Saturday, July 4th. Happy July 4th for everyone here in the United States. We're going to take a look at the market the way we usually do here on the weekend, and we'll look at the indices on a weekly. We'll actually take a look at some of our monthly charts, indicators, and then we're going to focus on a lot of ETFs today. Let's see, I've got 5 more I'm adding to our typical portfolio of ETFs that we look at. All right, we'll start off here with the Dow Industrial. So the Dow was down almost 28 points on Friday, or actually Thursday, I guess it was, which was July 2nd. We were closed yesterday for observance of 4th of July and to give everybody the holiday. But what I'm looking at here when I see this is, well, number one, the thing that jumped out at me is a lot of times it's pretty bullish that the market's going to be up like the day before a holiday, like the day before Christmas, the day before 4th of July, that type of thing. So in my mind, the fact that it was down, even though it was slightly down, just amplified the negative environment to me that we're in, that the market couldn't even close up on the day before the 4th of July, on the last day of trading before the 4th of July. So anyway, that's a thought I had on Thursday as I watched the way the market was acting. And then this does look like a little bit of like a pennant to me, like just a little bit of a consolidation, like a bearish pennant, if you will. You're down, you got the downdraft, and then this little bit of a pullback. So we'll see what we continue to get. I've talked about this support zone in here, that if it's going to continue down, it's going to need to get down through that and break down and trade down below the 233-day moving average. But this support zone is the critical thing that I'll be watching on the Dow Industrials. If we look at the S&P 500, a similar type scenario in here. I've still got the wave count on both of these indices that I just talked about. And here's the support zone again. Now, the Dow is a little bit further down versus the S&P 500. The NASDAQ, we've talked about how it pulled back. This was Wednesday, pulled back to the neckline, and Thursday. So we really just had, the one more day of trading, so don't need to spend a ton of time here. Similar thing in terms of this pennant type look. Pennant or flag. You could almost even say it's a small flag, but in terms of the look of this thing. So right now I would be expecting this to continue to break down, and here's the support line on the New York Composite. Russell 2000, our small cap indice. So again, weaker and acted on Thursday a lot weaker than the rest of the indices. And you can see we got the 10-day exponential moving average breaking below the 21 here, but definitely a lot weaker action on Thursday than the rest of the indices. If you go back and look at the Dow, it's all the rest of them were doing this pullback routine, and then the Russell 2000 basically closed down below the close of the last 2 days, almost got down to what was that, Mondays? Yeah. All right, let's look at a weekly basis. On a weekly basis, we've got the Dow closing here. I think it's pretty close to, I think I counted 9 weeks or more, something like that. In terms of the close, I think it's the lowest close since back over here on April 3rd. So, again, this is looking and starting to act weak. It looks to me like it's breaking down out of that wedge or that ending diagonal. S&P 500, same type of thing in terms of the close. Not rolling over quite as much yet. The NASDAQ, not nearly as much. Again, this has been acting a little more bullish, stronger than the rest of them, at least over the last 2 to 3 months. The next one, we'll take a look at New York Composite on a weekly basis, if I can find it. That's monthly. Oh, there we go. Okay, so this is the picture. Let me blow it up a little bit. So here we are closing at 10,864.82, and that is the lowest close since, actually it's below here, so lowest close since March 13th on the New York Composite. So again, we're starting to get this action pulling down and closing below a whole bunch of trading activity in here. And the next one is the Russell 2000 on a weekly basis. There we go. And again, this is kind of like the NASDAQ in terms of it's been strong, although this last week, pretty good little pullback, closed below the low of the last 1, 2, 3, 4 weeks. The lowest close of the last, let's see what this, 1248. Lowest close of 1, 2, 3, 4, 5, 6, 7 weeks, it looks like. So again, it's approaching, reversing the action of like basically the last 2 months. And let's see, so let's go back and take a look at our monthly real quick, just because we had June that completed. And by the way, I've seen some tweets and some guys that are doing a lot of analysis. The first half of the year has been one of the tightest years. I think there's only like one or two other times in like 70 years that the S&P 500 and the market's been tighter in terms of its trading range. So it's very, very compressed action, especially from like March, April, May into June type activity. And what am I looking for right now? I'm looking for the Dow on indefinite. It's right there. And it always knows where I want to go. All right, so now this has not broken down below the 10 bar moving average. So I'm using the same moving averages in here, the 10-day, 10 bar exponential moving average, so 10 month on this chart. And this is the 21, and this is the 55. Okay, and again, this is the simple, and exponential. So the interesting thing is on a monthly basis, and again, the way this all works is it has to start on the daily charts first, and then carry over to the weekly charts, which are starting to break down, and then the monthly charts. Okay, so it's just a rippling, it's a sequence that's going to occur. It hasn't gotten to the monthly charts yet in terms of any kind of breakdown. So that's what you keep watching for. That's why you start watching to see what's happening with the weekly charts. I am looking for the S&P 500. Okay, here's the S&P 500 monthly. Again, it's not closing below the 10-month exponential moving average either. So, but it looks, again, like we talked about, here's the close on February 27th, the end of the month of February, and you can see what we've done in a very tight range is just gone sideways for the last 4 months. Extremely tight trading. Okay, now let's take a look at the NASDAQ. And the NASDAQ is again more bullish, and this just reinforces that on a monthly basis, we're not even close to breaking down, I don't believe. We are getting some divergence though. So, there is this warning signals that are coming up here. And just like we're seeing on all the weekly charts on the indices, we're getting bearish divergence, and we're getting bearish divergence here on the monthly charts too. So even though this continues to trend high, it's trending higher in a weaker technical picture is the message that I would have to say about what I'm seeing. Okay, in the New York Composite monthly, let me move this out of the way here. Again, I've got this trend line drawn on a monthly chart from the bottom down here, and in March of 2009. And it looks like it's broken through that kind of sideways action also. But again, this could be just the start. And this is one of the ones a little bit weaker. We're now getting a close below the 10 bar moving average like we did back in January. So this is the first time since January we're getting that close. So weaker action on the New York Composite. The New York Composite's a little over 2,000 stocks on the New York Stock Exchange. And so it's a broader one for sure than, the industrials are 30 stocks, the S&P 500 is 500, the New York Composite's a little over 2,000. The NASDAQ is about 3,000, I believe. The Russell, of course, is 2,000. The Russell 2000, naturally. So that's pretty self-explanatory. And let's find the Russell 2000 on a monthly basis. Here we go. So here's the Russell 2000 monthly. And again, it's broken this trend line kind of sideways and continued to push up, hugging that trend line. Now seems to be pulling away from it a little bit. But the thing I'm noticing on the indicators is there's divergence with this move. Okay, this little move higher here is not confirmed by DI plus or by the relative strength, the RSI. And this is, again, I'm using a 10-bar RSI on all my RSI indicators. So a little bearish divergence coming in here on the Russell 2000 monthly chart. All right, that's it for the monthly. Let's take a look at our indicators. Short-term trading index. The key thing I'm watching here is the 10-day exponential average of this 1.26. So it's right in between these extreme ranges. So that moving average is still neutral, although it has been creeping up higher over the last few weeks, couple weeks. The next one is the VIX. Okay, the CBOE Volatility Index, VIX. It pulled back on Wednesday and then on Thursday, first thing when it opened, back to the trend line here that it broke. And again, we had 4 points making this trend line fairly strong, and now it rallied back up. And so a little bit of a not quite totally bullish engulfing bar, because I would like to have seen it close above the high of Wednesday, but still kind of bullish action. And so it's going to be interesting to see, do we get continuation back up to the high side? That's where I would be leaning at this point. All right, the next one we'll look at is the high-low. Okay, on Thursday, the high-low, we still had 69 more new lows than new highs for the day. And of course, the market was down slightly. So we're still, we're below zero, below the zero line here, although we did get a little bit of a snapback. So still a negative picture. We got the 10 below the 21. I'm only keeping 2 moving averages on this just to kind of keep it a little bit cleaner. All right, the next one we'll look at is McClellan Oscillator. And the McClellan Oscillator did something similar to the high-low index, in that it got down in this oversold territory and then bounced back up. And again, it's still below zero. I wouldn't be, it's hard to tell where it's going, but we're not down. I mean, I'm expecting it to pull back down again, probably get oversold again. We'll see. We've had several of these where as soon as it's gotten oversold, it bounces, and it bounces for, a few days to a few weeks. But if you look at back here in September, October, and even in July, those things, they failed. I mean, they came back down again fairly quickly. Right in here in September, came back down. It's got several, it formed this divergence in here, but you had several thrusts down to the downside. So given the environment, that's what I'm expecting to happen again, and looking for this to come back down. And the put to call ratio, the 10-day on the equity put to call is 0.68. So again, it's starting to rise a little bit because of the, what's been going on with the selling. So we're not at any kind of extreme reading on the put to call, 10-day put to call at this point. Let's take a look at the high yield bond fund. Okay, so here's the part of the video where I start to get into what I call key ETFs. They're kind of market market indicators type thing. High yield bond fund, again, I've talked about this risk off, and one of my subscribers, emailed me and said, hey, what do you really mean by risk off, and what are you talking about? Because it's confusing. Sometimes people rush to get into bonds as for safety, or when the market's going down. But the high yield bond fund, this is the riskiest of the assets. Okay, this is the riskiest of the bonds. And so people are, exiting this and taking risk off, and it's similar to what's happening with the market. And so when you look at this, when the animal spirits are roaring and everybody's like, oh yeah, let me take on some risk. I want those returns. I want to get in this thing. The market's going up. That's when you see this thing going up and rallying, just like the stock market was. 2012, 2013. And it's interesting how this whole high yield bond fund picture peaked out in May of 2013. So 2 years ago, it peaked out. Pretty substantial collapse in that June sell-off in 2013. Then we got this gradual rally back, but it never went to a newer high, and then it's rolled back over again, and it went to a lower low here. And you can see the picture that I'm talking about. It went to a lower low from that June 2013 sell-off. And here's where the market sold off in September, October, and then into November. So the picture that the high yield bond fund is painting is much, much weaker than what we're seeing in the stock markets. And this is an indication that investors are saying, no, I don't want that risky stuff anymore. Okay, so they're trying to get out of this. All right, let's TLT. Now we're into the bonds, and let me find it. Okay, so here's the 20-plus year Treasury bond ETF. And by the way, the subscriber who asked me that question was Jim, and I appreciate that question, Jim, by the way. And it's good. I mean, if anybody out there has got questions, it's great for us to. If I don't know the answer, I'll find the answer, and we can talk about it. So that's great, and I appreciate any of those types of questions and inquiries and all that kind of good stuff. If anybody ever has a question about what you see on a video, do not hesitate to just email me, and we can talk about it. And so here with the TLT 20-year Treasury bond fund continues to trend to the downside, which really is an indication that interest rates are slightly rising in the long term. Okay, long-term interest rates are slightly rising because when the price of a bond goes down, that means interest rates are going up. When bonds are going up, it means interest rates are dropping. And so that's the scenario that we're seeing right now. The next thing I want to take a look is the US dollar. And hopefully I can find that fairly quickly. And there it is. It's a short name. And here's the dollar continuing to push higher. And I've still got this scenario marked out. I still think we're working another 5-wave up in a fifth and final intermediate, motive wave here to the high side. And again, if the dollar's rising, I'm expecting oil to be dropping, and that's exactly what's starting to happen. Let's find U.S. oil. Okay, United States oil, I talked about how this was really compressed and consolidating, and now it's breaking down. And I have a feeling that that's working in conjunction with the fact that the U.S. dollar is strengthening. So we'll see how those two continue to play out. Now, again, oil is a commodity-based thing, so it's not totally related to the dollar, and I understand that. It's, there's supply and demand and all that good stuff that's going on in the world. But the dollar also has a big influence. All right, and the last one we'll take a look at here on the market related is gold. Okay, so GLD is the gold shares ETF, and I'm looking at this, and I've now gone to my alternate account. I just don't think this is acting like it wants to go up. It just looks and acts like it's getting ready to break down. So I'm going with the fact that the fifth intermediate wave down has not been completed yet. So I'm going with this 5-wave minor wave 1, a 3-wave minor wave 2 pulling back, and that we're working a 5-wave minor wave 3 down. And so we're gradually still working our way down is the take that I'm going with at this time until I see something totally different. And here's the support zone that I've got marked out. It's down around here, around 100 to 102 on GLD. And actually, I wouldn't be surprised if this broke down and came all the way back down here and tested the lower end of this channel and got down to this. This is where I'm doing some Fibonacci projections of where I think this might go. And it's a little premature because we need to see this start to break down. What I want to do is, to confirm the scenario I've got here, what I just talked about, it needs to take out this low and show us, but it sure is acting like that's what it wants to do. All right, let's take a look at the semiconductor, some of the sector ETF. Okay, SMH. So SMH, was acting real bullish back up here at the end of May, and then all of a sudden, bam, bam, and we got this quick, very quick sell-off. We're down here. They're testing the low. Where is this? Back down close to 52 and a half in this range. It's going to be down in this 52, 52 and a half, where I think potential support's going to come in. So right now, the short-term and intermediate trend are turning lower. The long-term trend is still up. I mean, there's no doubt about that. But right now, it looks like it's starting to break down. It broke this trend line here, and you would have to say it broke another, intermediate trend line there. And then actually, because we've had a few higher lows on the daily chart off of that low there, you could draw another short-term trend line. And if it breaks that, we're going to see that come down and test that potential support area really, really quick. All right, the next one was the home builders. Okay, XHB has been holding up in here. The short term hasn't, we did get a couple days of trading below the 10. Now we got one above. We're back down with another close below the 10-day exponential. The 10 hasn't broken below the 21, so short-term trend hasn't rolled over yet, and we haven't broken this trend line from the low in early May. So this has held up so far, and we'll see. That would be what I'd be watching for right now on XHB. Next one is the financial. Okay, XLF has broken this trend line. Remember when I talked about how, it was trying to rally in here, it pulled back down to this neckline, rallied off of it, pulled back down, it was sitting right here. And then on the 29th, which was Monday, it just smashed right down through that with that huge market break. And so this trend line from starting in October has been broken. And so now the real key is it looks like got support right in where all this congestion is on XLF, bounced, and now the real question is, what is it going to do now? Is it going to resume to the downside and start to roll over and take the 21 below the 55, which it hasn't done it yet, but we'll be watching to see. It's going to need to take out this Monday low and show that it wants to continue to come down if that's going to be the case. But the fact that it broke this trend line is a fairly big negative here on XLF. And next one is biotech. Okay, IBB continues to try to trend higher, and I think even when I looked at this on this thrust up, there was not any bearish divergence. So there was no negative related to this move right here. So this move here looks solid. Then all of a sudden we get this pullback and we're into this congestion here. I would have thought that if it's going to stay bullish, it would have held up above this close here, but it didn't. And this short-term trend line here has been broken. And now we pull back up here. We're still closing below the 10. I think both of these closes below the 10. There's a good chance this is going to continue to push back down and continue to roll over. We'll see, but that would be my guess right now, and we'll just watch to see whether that will happen or not. But you have to say at this point that the 10's above the 21, above this, all the moving averages are still aligned up. And let me validate that the 10 is still above. Yes, it is. It is. The 10 is still above the 21. So I like to, when it gets below, there's no guarantee that just because it broke below, but that it's the short-term trend is rolling over. But it's when it does, it's going to be happening. So you sit back and say, well, okay, it's a good possibility it might be happening, but you don't have any. There's no certainty with any of this kind of stuff. So that's why you have to have your stops. And when it's ready to roll over, like right here, it broke, rolls over, and it dove, came back down. But again, it's the timing of what's going on with that particular indice or the stock. So let's take a look at the next one, which is the energy. Okay, energy sector, XLE, continuing this trend. I've been talking about this for weeks now. It just continues to trend. And here's a perfect example of when this baby rolled over and the short term, the 10 broke below the 21, it just just kept heads down and just kept doing it and kept doing it and doing it and just kept pushing. And right now, everything's aligned to the downside with, the 10 below the 21, below the 55, below the 233-day moving average. So here we are rapidly approaching this low here, 73.82, which I wonder if it did 73.9, pretty close. So it's coming down to test these lows in here, and it's going to be, it's going to be interesting to see whether this is going to hold or whether it's going to break down out of this, what looks like sideways consolidation. All right, the next one. All right, now we're going to take a look at something we have at the gold miners. Okay, so this is the first time I've looked at GDX, and right now GDX is continuing a pretty solid long-term trend down. It's pretty much going in sympathy with gold. I haven't looked to see what an Elliott wave count is exactly on this, but just looking at the breakdown, I mean, clearly, lower lows, lower highs, breaking these swing moves. And it looks like we even have another, like a head and shoulders type consolidation, although this shoulder ended up being pretty big compared to the left one. But when I drew that trend line in here, it just fit and it created the scenario. It's like I see this and I see these key points, pivot points first, and I connect them with the trend line, and then you kind of get the picture. And right now, all the moving averages are aligned down negatively. And on Wednesday, it broke this trend line. Thursday, it pulled back up slightly, although it was an inside bar, basically, inside the trading. So I wouldn't call that super bullish, so that's the scenario on GDX. Looks like it's continuing to push lower. And let's see, the next one is IYR, real estate. Okay, so this is the U.S. real estate ETF, IYR, iShares U.S. real estate. And so you can see here, again, the intermediate trend is turned down. The 21's below the 55. 55 is rounded over and coming down. A whole series of lower lows, lower highs. As it's trending down, and it's starting to pick up steam. And this trend line here that it's breaking is a trend line from back in late 2013. First created the first pivot point back in December 2013. So we're really talking about a 18-month or so trend line that has now been broken. It broke it back here in June, early June, pulled back, quick snap back here in the middle of the month, and then now has rolled over pretty sharply. So I think, the next area of support is going to be down. Let me put my crosshairs down in here. Previous high, previous low, probably going to be in that 69 to 70 range down below. So that's the scenario on U.S. real estate. And maybe part of it's because interest rates are starting to creep higher slightly, although it's pretty subtle on that move, I think, here in the United States at least. All right, the next one we're going to take a look at is healthcare, XLV. And the only thing I've got to say about XLV is it just continues to push higher. It just keeps riding. It's getting real choppy though since December, but the choppiness has continued to gradually go higher. And when you look at this ETF, which I have not been paying attention to, that's an amazing trend that it is in since the bottoming down here when we had that U.S. government financial crisis in 2011, summer, fall 2011 when we bottomed. And wow, this is just taken off and just kept pushing. Yeah, there's been some a few little sharp corrections in here, like September, October, but looking pretty solid. And I don't think, let me take a look, I'm not really seeing, I'm not seeing any dramatic divergence on RSI. I mean, this continues to push higher on DI+. Demand index, maybe. So maybe one out of my three indicators is showing a little bit of divergence. So we'll see. On a short-term basis, we are getting some closes below the 10, several of them. But we don't have the 10. Let me take a look. Now the 10's still slightly above, if not right at, the 21-day. So this isn't rolling over yet, although it may be starting to, but there's been several times where that would have faked you out in the past here on XLV. And the last one today is the technology sector, XLK. Okay, so XLK is showing some of the same kind of volatility the market's been showing, the overall market, since December. But right now, it looks like this. Like you can draw a trend line here from the October low back up through the lows here, and it's been broken. It was broken on June 8th. That trend line was broken fairly substantially, pulled back to it, came back down, pulled back up again, and now has rolled over. So it looks like it's breaking down some here. You can almost even make a case for a small head and shoulders right in here, very short-term type thing. Support area is right in here where it seems to have gotten support. If it takes out this low, then it's going to test the December, January lows pretty quickly, I believe. But right now, you'd have to say the short-term and intermediate trend have turned down. It's broken this trend line, so it looks like it's rolling over, and that's what I'd be wary of and looking for and watching pretty closely. All right, so that's the picture on XLK, and that kind of wraps it up for today. Long video. So if you're watching this video anywhere besides my website, head on over to the website, check out the posts, and if you're not a subscriber, subscribe. It's very easy to do, first name and email. And you get access to Trade Ideas page and the free PDF I've got for you. And let's see, I'll be back on Monday night with another market update. We'll see how the week's going. And of course, the big news probably for the weekend is Greece. Greece having this big vote that they're having tomorrow. And we'll see where that goes. So until Monday, have a great weekend, everyone. This has been Joe for Beyond the Chart. And remember, this is your source for exceptional video analysis of stocks, ETFs, and indices.